Let's turn to property because we had some figures out today, of course, with CoreLogic. House prices rising by 1.1% for the past month of November and 21% nationally over the year. Regional house prices collectively rising by 2.2% in the month. To take us through the latest for both owner-occupiers and investors, Anthony Landahl joining us from Equilibria Finance. Anthony, great to catch up again. Okay, so just take a look at those latest numbers. So some heat coming out, I guess, particularly in the largest cities, but not so in the regions and towns. What's going on there?
Yeah, g'day Andrew. Good to be here, mate. And yeah, what the latest data is showing us is there's been a confluence of factors. We've got an increase in rates. We've got increased supply in a lot of the major capitals. We've obviously had APRA stepping in and increasing buffer rates. And we're actually interestingly seeing a bit of a two-speed market open up where, as you hinted at, some of the major cities, we're starting to see a slowing in growth coming off that 2.5% a month. Sydney, Victoria, Perth, they're starting to come back around 1.5% to 1.3% a month. But interestingly, areas that maybe have been a little bit isolated from the frenzy around Brisbane and Adelaide, they're seeing the strongest growth over the last couple of months that they've seen in some 20 years, up and around 2.5% and 3%. So it seems like we're hitting a little bit of a two-speed growth nationally, where we're seeing a slowing in some of the majors. But Brisbane and Adelaide, particularly, where affordability hasn't been such an issue, we're actually seeing some of the strongest growth we've seen in those areas for close to 20 years.
So Anthony, where are the opportunities then if there are investors with cash on the sidelines ready to go? Where should they be looking?
Yeah, that's a really good question, because often interest rates may not have the same impact on an investor strategy as maybe an owner-occupier. And we're seeing an increase in the rates at the moment where, as an investor, might take a longer-term strategy. So for an investor, obviously cash flow is critical. Investors are seeing opportunities now in some of the regional markets where rents are starting to come back into play. We're seeing a shift in what tenants are wanting, a shift in the areas, and a shift in the sort of properties that they're looking at. So we're certainly seeing investors back up around 30% of credit applications back in the market, looking at some of those regional areas where the rental yields are coming back, and also where there's a little bit more clarity around what tenants are looking for at the moment. And we're seeing a bit of a shortage of supply in those areas for rental properties. The second area we are actually seeing some investors come back in the market is interestingly enough, units. There's about a 40% difference in affordability in the major capitals between fully detached houses and units. And a lot of investors are now seeing that units, which have had an oversupply, which have been essentially on the nose for the last couple of years, a lot of investors are seeing opportunities there for good long-term investments where, as the borders open up, as the universities come back, as people get back in the cities, the demand for rental is going to come back, and they're going to potentially get themselves a unit at quite a good price.
Yeah, most immediately though, that appears to have been derailed to some degree, certainly as far as students coming back, because of course we've got those new restrictions as far as students coming back into the country. So Anthony, I guess it depends on how long that will last. Also, I'm interested to get your view in cities with units, whether you see there's going to be some impact with, given the glut we're seeing in office space and potentially the structural change we're seeing there, that some office space will in fact be converted into residential.
Yeah, we're absolutely seeing a shift in office space. We're seeing a shift in terms of what the space is. The space is adapting to what people need and what their businesses need. And you're right, we're also seeing a little bit of a shift towards some residential opportunities within the cities. But it's a difficult time through this time because there's already a little bit of a glut in residential space within the cities. But again, some investors are seeing that as an opportunity to establish that footprint. And to your point a little bit earlier, Andrew, you're right, there is a little bit of a slowdown with the borders opening up. But for most investors with a portfolio looking longer term, they are seeing that unit space with the cities opening up, with the lockdowns as a general rule not being the reactive tool they have been, they are seeing some of those opportunities there, including some of that commercial space either being reworked from an office perspective or being viewed from a residential perspective in the inner city areas.
Anthony, let's get a bit more detail on the outlook for APRA and their lending regime. They have announced that bank capital needs to increase. What does this mean for small businesses?
Yeah, APRA recently came out and announced some capital adequacy changes that are coming out in about 12 months. And the main areas it's focused on is high risk lending for consumers, but also small business lending. For small businesses, interestingly, APRA have lowered the capital adequacy requirements, which should make some small business lending a little bit easier. The second thing they've done is they've increased the lending cap to 1.75 million in terms of their definition. So they've lowered the capital adequacy and increased the cap. So for small businesses, hopefully that's good news, because about 20-25% of small businesses have really struggled to get funding over the last couple of years. So hopefully that opens up some investment opportunities, some growth opportunities for small businesses and more broadly the economy. Conversely, they have also made some changes around interest only and high loan to value ratio lending, seeing that as riskier and increasing the capital adequacy requirements. And that'll probably impact investors mostly.
Yeah, do you see that coming through next year then perhaps? And which particular part of the investor market do you think, and what sort of price level is that likely to have the greatest impact?
Yeah, it's probably going to have the greatest impact on investors who are already fairly highly geared. So they're trying to borrow their maximum amount across their portfolio. And it also has to be careful it doesn't have an unintended consequence for investors where they make interest only lending a longer term harder to access. Because for investors, a lot of it's about cash flow and access to credit. And secondly, for investors, they want to make sure that interest only lending doesn't end up in a sort of a non-standard product, because for investors, interest only funding makes a lot of sense when it's part of a broader strategy. So there's got to be some caution around how that's managed for investors. For owner-occupiers, I guess the good thing that's come out of it for there is they're seeing owner-occupier principal and interest lending as less risky, and they've actually lowered the capital adequacy requirement there. So that should help home buyers getting in the market. But I think it'll have the main impact on highly leveraged investors and those with a broader portfolio with longer term interest only strategies.